Welcome back to Kryptolytix, giving you a fresh take on crypto analytics. Today is the first installment of a series of videos covering potential trading strategies using the Market Cipher indicator on the 5-minute time frame. The first batch of these strategies were prepared and tested during the most recent market rip. So the idea of these is to prepare for the next time that price action does this, regardless of where it's from. The great thing about these strategies is they don't worry about price predictions, since they are on such a small time frame. As long as price action is following a certain pattern, we can apply the appropriate strategies to accommodate for it. These are not intended as financial advice. They are rather educational, showing a few battle-tested strategies with a higher probability of success. Scalp trading is fast-paced. Like driving an F1 car, you need your helmet and your harness on. So in this case, we need stop losses, as well as an entry and exit plan, and only take higher probability, low risk trade setups. The hardest thing about day trading is managing emotion and risk. Some trade setups that tick all the boxes may not be applicable if the stop loss in the trade is too far from the entry price. I'll cover these things in more detail throughout the series. And remember, I'm not a financial advisor, and this is not financial advice. These videos for educational purposes only. So let's get into the video. So first, just going to cover a couple of things here to start off the series. I'll probably touch on this each video just to remind everyone of what tool we are using in order to execute these particular strategies. It is the Market Cipher indicator, and if you have TradingView, you can get it by typing in VMC and get the Market Cipher A and the Market Cipher B indicator. Just to remind everyone, this is not financial advice, for entertainment and educational purposes only. These strategies are designed to help show some of the potential ways we can try and develop a strategy to take advantage of small moves on lower time frames. It's important that you do your own backtesting and research to make sure that these work for you. I'm using the Solana ticker because I like the way the price moves personally, but you can try these strategies on everything. It's just recommended that you go and do some backtesting. It's a good idea to use the bar replay function, which is only available on the pro version of TradingView. Alternatively, you can just hide future candles and then move forward incrementally, because if you're looking to see if something's going to work or not, and if you would take the trade, it's better that if you can't see future price moves. And just remember that investing and trading carries risks. Make sure that you can only invest what you can afford to lose, and isolate trading accounts to make sure that you don't wreck your entire portfolio if you make any mistakes. Things as simple as setting the wrong orders, going in the wrong direction, accidentally opening a huge position are a number of the things that can go wrong. So just make sure that you are protected before you do anything like this. And I'm not recommending you do. I'm just showing you what's possible using this particular indicator. So the Market Cipher contains a few different elements. We have the wave trend, which is this thing down the bottom here, in the Market Cipher B, which is a momentum oscillator that crosses and creates dots according to the cross. The zero line is basically in the middle here, and then underneath is considered oversold, and over the top is considered overbought. The dots are these little dots right here, and the divs are these lines that join the dots. Basically, the divs show when there is a divergence between price and the momentum oscillator. Divergences are often a good sign of price reversal or the exhaustion of a particular trend. This is a low time frame though, but they still are relevant. And you'll see based on a few of the strategies how they still work out. This blue line here is the stochastic line. Again, another momentum oscillator. It's very helpful for looking at, again, if we're overbought or oversold, or if this particular trend is exhausted. And lastly, we have the EMAs, which are these lines right here. The EMAs help show us momentum behind the current price move. In this case, if they're blue, we're looking at a short-term bullish trend. And if they're gray, we're looking at a short-term bearish trend. Sometimes they flop back and forth, but when you get these nice trends, that's where we can start looking at taking certain trades. And there are some strategies that involve using the EMAs. So it's important to know and understand how they work. Basically, when they cross, they flip color. But for the first strategy, we're not going to worry too much about the EMA lines. We're just going to be talking about the wave trend and the divergences. First up, we have the 3-point div chain, which comprises of divergence with 3 linked dots. And we're going to go through a long trade example. So you can see basically 3 dots that are chained with divergent lines. They're pretty rare, but they are quite high probability of success. You enter your position at the candle close with a green dot with divergence, and you set your stop loss to the wick of the previous structure low or swing low. And take profit is aggressively set to 25% of the entire position every 1% price move. So here's an example here, and you can see there's a little table I've put on the chart to show the entry and where the take profit points were, and also I guess where the trade was closed. So in this example, you can see down the bottom, there's a line here that crosses over here, and then there's another dot here. So this is what I mean by the 3 dots are chained together. During the most recent price rip, most of these played out successfully. So they are quite a high probability of success, which is really good. Probably my favorite one of these strategies, which is why I'm covering it first. So basically the way this works is you enter on the candle close. So in this case, it was right here on this dot. Essentially, you just have to jump straight in. A lot of the time, the candles don't quite come back down below because it's usually entering a bullish phase, at least in this case, or bearish phase on the opposite side. So you can see here that the first profit point was taken here, the next one was here, then here, and then the trade was finally closed up here. So I'll just quickly show an example on the live chart of how this has played out, and show also a few times where it hasn't worked out so well. Because like any strategy, there's going to be a few losses here and there. So in the interest of transparency, it's best that I show you both, right? So just keep in mind when testing strategies that you can only really go back like a month or so on the 5-minute candles. So if you're going and back testing a strategy, then you don't have a lot of data to work with, but usually it's enough, at least if you're testing a certain type of price action on a larger time frame, whether it's worked or not, based on where we are now or based on where you're trying to prepare for when things go back to that kind of price action. These all had a higher probability of success during the market going up. So what I like to do is I've got this chart here with this buy and sell Bollinger Band indicator, which I covered on a previous video. But this particular indicator, you can just type in BB, and then it's the Goikhorov indicator, this one right here. On the 1 hour, at least on Solana, it shows when we are in a bullish trend and when we're in a bearish trend. It does get a little bit choppy sometimes, of course, but you can also just use trend lines to work out kind of where we're at as well. But these worked really well during these price moves here, basically. So these are the rips that I was talking about, and basically where this strategy worked best for the long side. And for the short side, the bearish divs worked pretty well here, but again, they're pretty rare. So they're kind of a gold mine when you come across them. They do fail sometimes though. So here's the first example of the 3-point div chain. So as you can see here, we had this price action here in early June, and basically we saw that we had 3 consecutive dots all chained together with this line right here. So basically right here is the entry point. So this was actually the example on the slideshow just prior, and you could see the entry point was here, and these were the take profit points at the 1% price move interval. So let's try and find another one. So here's the next one, and you could see this one didn't quite play out. So this one's entry price was right on this candle here. So you can see there's the third dot there. This one actually chained out to another divergence in the future, but the first dot was all the way back here, and then basically chained together over here. So the entry was right on this candle here. 1% was taken here, and then basically the next one was here, as we can see here, and then the stop loss was here. And the reason why that is because price came down and hit the previous structure low. So there's the previous structure low there, and there's the stop loss being hit basically. So let's look for the next one. Now I'm not sure if it would have been smart to take the next one in this chain, because clearly it was a sign that we were going sideways or down. So I mean, if you took this right here on, there's still at least a 1% there, and so it would have put your position down to probably around here somewhere. So if you did get stopped out, then it probably would have been a break even or maybe a small loss, and those definitely happen, there's no doubt about it. And here's another example of a just pure loss. This one did not play out nicely at all, unfortunately, and this is kind of what's going to happen. And thankfully though, the risk on this was quite low. The risk was about 1%, just 1.5%. So this is just showing that yes, they can fail. So here's another one here. This one's entry price was right here on this candle close right there. As you can see, there's the third dot, and there's another one in the future. We'll have a look at that in a second. But as you can see there's the profit points, and eventually the trade was closed there before we came back down essentially and continued on going down or sideways. But we will see in a second where price actually went. So yes, price went down, and this was the next one here. Quite a few chains in this one actually. This one, entry price was on this candle here, this candle close, with the stop loss right there. Took the 1%, took the 2%, and then went down and stopped out. Well and truly in profit at this stage because profit was taken. So that's the benefit to taking profit, is that it moves your position down. Now, if you see so many chains in a row, I'm not sure that it's smart to keep taking them. Again, this is actually price coming down. So the probability of these succeeding is significantly lower as compared to when price is actually going up and trending upwards. So that's where looking at the higher time frame and working out what kind of trend we're in is a really good idea. But even though we've been coming down, things still panned out. So here's an example on the short side. So it's the same rules, just in reverse essentially. So you wait for 3 dots, but instead on the bearish side, so bearish divergences. And so you enter there on this candle close right here. First profit point was on this candle. So at this stage, you're sitting in a much better position. And then the next one was here, finally here. And then basically the last profit point was over here, essentially. So that one played out nicely, which is really, really nice. And then it was very quickly followed up by another one. And remember, you're not going to be able to take all of these because, you know, some of these are when you might be asleep. So a lot of these will get missed. But let's just continue on and just have a look at a few more examples of this kind of working out. So entry price on this was here. So you could see 1, 2, 3 chained up together. The first profit point was on this candle here. The next one was on this candle. Then we came back down. Maybe you moved your stop loss prematurely up and got stopped out here as a possibility, but in profit at least. One thing to look at is also the wave trend in terms of moving your stop loss. You can move your stop loss with the wave trend. So for example, once we go above in the short side and come back down, well, you could set your stop loss to wherever that is. So in this case, your stop loss was still down here on this trade until we got down below and formed a swing here, and then basically you move your stop loss to this structure, this swing, and then basically the last parts of the trade were closed here and here. Seems like there's another div here. That would be right here. So there's the next link in the chain. Maybe it's far enough away. I think if the risk is low enough, it could be worth giving it a crack. But again, that's completely up to you. It's up to your risk tolerance. So you can see in this case, we had another successful trade. So the entry point was here, profit points there, there, there. And I think this one was stopped out down here. So if we have a look a bit further on, you can see that there was a structure. The next structure was down here. It's kind of messy, but you could call that as the where to move your stop loss to would be here. So basically if your stop loss was moved to either here, or even if you just left it here, because this looks like a decent structure, we didn't quite get down underneath the wave trend. This is where you kind of just need to look and study the price action to kind of work out where you want to be moving your stop loss. The wave trend is just an example of where you could possibly put it, because in this case we never actually got down and formed a nice shape like something like this. So in this case you can see that we would have stopped out there. If you moved your stop loss to here, or if it was here, you would have stopped out there. Either way, very similar, and again a profitable trade. Now there's got to be one that's a loss in here somewhere. Let's try and find the next loss. So here's the next point to enter. This one was not a loss. This one closed as a win, as you can see. This grid here is just a series of time and price boxes, and I've just set it up so that basically you can see 1% moves. So it's just the date and price range tool right there, and I just draw it on the chart so I can see when I'm entering a trade, so I can see what I'm looking at in terms of where my risk is and where the profit points are for the most part. So in this case the entry price was here, and you can see that went up and closed out in a profit. So you can see that this trend going up overall, the most profitable trades are the bullish divergences. There aren't that many bearish divergences. They happen more when things are going down or sideways. And down or sideways is where things can sort of get a bit choppy. So here's a losing one. This one was, I think, a stop, but in profit. So you could see the entry price was on this candle here. There's the dot. First profit point was here. Next one was right here. And then we came down, and if you used this dot point here for your structure, the stop loss would have been there. Or if you used this as your structure, then the stop loss would have been there. Very similar, both closing in profit because we took 50% of the trade out already. So the break-even price is significantly lower because you've taken a whole bunch off the table. So here's an example of a pure loser that just did not succeed at all, unfortunately. So here was the entry price, and here was the candle, and basically that one actually got a 1% right there, and then stop was there. So it might have been break even actually in the end. If you're wondering what the rest of these boxes are, they're actually different strategies, which I'll cover later on. But all the strategies in the first series, these first 4 strategies, have been tested with this most recent series of candles, basically, about as far back as I could go. So I'm not sure if those are linked. You can kind of see they look like they are, but I don't think they actually are. I think this is just joining this one to this one. But yeah, if you did kind of mistake that for an entry, that would have been a losing trade. You would have been stopped out right there. Right, so that would have been the entry there, and then the stop would have been there at a 2% loss, which isn't really ideal, but they do happen. So here's the next one. This one was a win. You can see right here, there was the entry point there. The entry price was right here, and take profit was there, there, and finally there. So that one was fine. There will be losses, and you'll see that they do come in later on, especially when things start to get a bit choppy and the market starts to turn around. And that's where going out to a bigger time frame and checking to see where we're at is also really important. And that's why having something like that 1 hour chart and drawing in your trend lines helps kind of work out how things are tracking and what trades will most likely have the highest probability of success. But yeah, these rip phases are really nice with these strategies. Okay, so the next one was here. You could see their entry was there, profit point, profit point, profit point, and profit point, and then the price just kept doing its thing essentially. The short side, there was a short side one here. So the entry point was on this candle close. Again, profit point all the way down, and then close on this candle here. So here's an example of a 3-point div chain that didn't work, but then did shortly after. So you could see 1, 2, and 3. Entry point for the short would have been here. You wouldn't have even gotten any of your profit points filled on that one, unfortunately, and been stopped out on this wick here, unless you had your stop loss a little bit above, but that's probably a little bit more advanced, because what can happen is, and another consideration which I'll cover in a second, is stop loss hunts, where price goes a little bit above the previous wick just to collect liquidity before heading into the direction that you were heading in originally anyway. So here is the short next one. So there's the dot there, and the entry candle was this one here. And then basically these are where the candles closed there. This one I believe though was a stop loss. Oh no, there's the exit there, down there. So that was a successful trade. And here's the short side. I believe this one stopped out as well. So this one was entry point was right on this candle there. Stop loss would have been, you probably could have set it here, but most likely here, and then moved it down. When setting your stop losses, you kind of want to have these like lower low formations, at least in the short side, or higher high formations. And then when that higher high or lower low is formed, depending on which side you're taking, in this case, we'll just say lower low, at least from here, that's where you can say, okay, well, I'm going to move my stop loss to here if it's here, which is very negligible, but you know, that's pretty much the rule of thumb. And you could see that there was the stop loss for this one, I believe was, so you probably set your order to here. It didn't quite get as low as the last quarter, so I would guess that you would have been stopped out here, because you probably would have put your stop loss there and then wicked out there. You can see a short here that was I believe it was probably a failure because there was no structure above to put the stop loss. So this is an example of it where it would have played out, but then classic stop loss hunt basically would have taken you out here. So you wouldn't have been able to take any of this basically. And that's going to happen, unfortunately. So yeah, that would have been a small loss. That would have been about a 1% loss. Okay, here's another one here. So we've got the entry, first profit point was there. This one is a little bit contentious because, and that's why I like to put my stop losses a little bit below the candles rather than on the candles. These wicks can be quite annoying, and they do happen. So in this case, I didn't get stopped out, which was nice. The first profit point was there, and then further on, the next one was there, and then there, right there. That was the close of the trade. It was a stopped out short that was still stopped in profit. So why was it stopped out is because it didn't quite get the last quarter. So if we ever look into the future, the stop loss was here basically. And let's see where that was. And that would have been right there on that candle, on this swing here essentially. Or if you set it to here, I guess as well, could have been there if you saw that dot. But either way, it wouldn't have been much of a difference. And here's a short. This one here, I think, was a stop because the entry price was on this candle here. First profit point was there, second one was here, and then a bit messy, but if you use the dot, that's where your stop loss would have been, and then that's where the trade would have been closed. Okay, surely there's a losing trade here somewhere. Here we go. This one was a stop loss. So opened there, stopped out there. So yeah, that's basically an example of where things don't quite pan out, and that's definitely going to happen, no doubt about it. Here's a short here. I haven't actually gridded this one. I don't think I took this, but this would have been all right. So you can see it's probably like entry was there, stop loss there, and then profit points probably would have been somewhere like here, here, and then maybe a stop out here. So close in profit basically, because 50% of the position was closed at this stage. And this one looks like it probably would have been a stop out, not in profit. So let's have a quick look here and see. Oh no, that would have been fine. This one here. I mean, I can go through these all day, but I think you get the point. Tracing all the way back, this 3-point div chain has a very high probability of success. They're not that common. They only come up a couple times a week, sometimes when you're asleep, so it's not like you can take them all, but they're pretty good. Even when price is coming down. You saw price has been coming down ever since up here on the 26th, and they did get more rare as we were coming down, but there were a few here or there. So if you're looking at the 1 hour time frame and you're gauging where we're at, you will see which ones will come up more often, essentially, based on the current price moves. I'm just going to cover some extra considerations with regards to taking these trades. risk management and stop losses are very important, as previously discussed. You need your stop losses in because things can really turn around on a dime. No one knows what price is going to do. Well, maybe whales do, but us mere mortals don't. It's good to look at your high time frame RSI and stochastic and support and resistances to see where we could turn around. And an example of that would be right now. For example, you can see if we're looking at the high time frame, we could see if we drew a Fibonacci from the lowest point down here to the top, we came down to the 618, which is a very significant level. And then we bounced off the 618, blasted past the 5 to the 382. And this is probably where we might get rejected and maybe continue heading down more, or maybe we'll test this trend line, for example. Maybe we'll do something like this and then keep going down. We don't really know what's going to happen. But as you can see with regards to these trading strategies, they don't really worry too much about price predictions. As long as everything lines up perfectly and all the boxes are ticked, then we can take the trades and have confidence that they'll work out for us, at least with a high degree of probability. The next consideration is fundamental analysis, because sometimes the news can actually play a pretty major part in what happens with the price. Now, when I cover some of the other strategies, these should be considered, because when the trades are a little bit lower in probability, things like fundamental analysis can change how price will move. For example, when the Solana phone was announced, Solana had quite a bit of strength, even though the other altcoins in the market were starting to fall and break trend, Solana was going up. So there was a trade in there that uses one of these strategies that didn't play out because, well, the market was bullish on Solana because of the news. Another consideration here is contradicting signals. So basically, if you're in a trade and you have two contradicting signals, and I'll show some examples of that in the future with future strategies, the higher probability play will always win. So if you're in a trade that hasn't quite played out yet, and the higher probability trade is printed on the chart, then you just bail from where you are and set up in the opposite direction, which is generally what happens when there is a contradiction. The trade will be in the opposite direction. So it's better just to pull the pin and then set up for the opposite direction. And as previously discussed, managing emotions can be tricky. When first starting out using strategies like this, it's better to start off small and then just keep position sizes small. You kind of need skin in the game, otherwise you don't have the same emotion as paper trading. Paper trading doesn't carry that emotion because there's nothing attached to it, so you don't make the same decisions, essentially, compared to when you have something riding on the trade. And most importantly is when you start off with these, you start off with a small amount of capital and test for a few weeks at least, because price action changes all the time, especially on these lower time frames. So it'll take time to kind of figure out what works and what doesn't. And the last thing is pretty annoying, and it happens often, especially with the other lower probability trade setups, is you get stop loss hunts. They are very common. So you'll have your stop loss set on the chart to a previous structure low, previous swing low, and the next wick that comes will just go a little bit past where your stop loss is, and it'll basically take that and then move back into your trade's favor. It happens all the time, and it is frustrating. In a future video, I will show how to set up a bot in FTX to set all of these up for you. But for now, it'll be completely manually managed while you're trying to figure out how to use this strategy. So that's it for the first video in the series. I hope you found this educational. I hope you learned something from it. And if you did, please leave a comment in the comment section down below, or even leave some criticisms. I'd be happy to hear them. And leave a like on the video if you liked it. And remember to subscribe if you like this content, and turn the bell notification on so you get notified on all future videos in this series. Take care, manage risk, peace out, and all the best. See you next time. This is Kryptolytix signing out.